All right, Dina. So this is the first question that we have over here. We're supposed to be finding the WACC, the weighted average cost of capital, given the following um, sources of finance. So we have long-term, short-term, and ordinary shares, and the total uh, of all sources are 35 million. And you're supposed to be using this market value instead of the book value, because that's what um, they usually do. Now, take into account 25% corporate tax bracket and a debt to equity ratio equals to 2/3. So let's check out the questions here. So what's the company's weighted average cost of capital? That's gonna be 11.52, and the way I got to that number was, well, as you can see, we have columns F and G here, which are new. And with that, all I did was to find the weight of each of the sources of money. So, for example, the long-term debt, since it is $3 million, it's 3 million dollars. Sorry, that's pounds. 3 million pounds over 35 million pounds, and so for the rest of them are gonna be just like you see over here, and you can see very closely when I sent you this file. So that's basically the percentage in terms of the total market value. Okay, and this is the after tax cost. So the formula is that you take the cost, which is in this let's see, cost times 1 minus taxes. That's what I did all the way down. But I only did it for this and this because your equity is not subject to tax deductions. So it remains at 15%. So all you have to do here is to multiply the weight times the after tax cost of a debt. And then you add this all the way to the end here, and you get 11.52, which is the same. Only here I did this more sophisticated formula, or more elegant formula, which is multiplying the vector, this weight vector, times the after-tax cost of the debt. But that's basically it. So there are two ways to find this, and one of them is the one I showed you before that I erased, which is I'm not gonna erase, but I'm gonna send it to you so you can see how it's done. Okay, great. Now, what's the company's weights for debt and equity using the company's target capital structure? So that'll be 2/3, right? Debt to equity ratio was 2/3. So if you have £2 in debt, you're supposed to have three in equity. That means that 2/5, it's gonna be your percentage of debt, and your percentage of equity, it's gonna be 3/5, which is the sum of 2 and 3. That's how you find the percentage of your debt to equity ratio in terms of debt and equity in percentage. Now, assuming that the company only has long-term debt, in this instance, what's gonna be the WACC? So you're gonna be using the same percentage over here, and then you get the after-tax cost of the debt, which I didn't calculate again because I already have it over here, just 3%, and this still is 15%, and then you got the sum product of this. So this is like this times this, and then this times this. And then you add this up and you get the same result. I'll just go ahead and show you real quick again so you can check one by the other what the results are. You see, that's the same. So that's all for question 1. Let's go to question 2. All right, now we have this company, and they're exploring the option of having being of being 25% financed with debt instead of 100% equity. So for that, we have that the current number of shares outstanding is 33,000, which are, and the price is £45. The earnings before interest and taxes is expected to remain at £18,000 per year forever. And the interest rate of the new debt, that's going to be 8%. And there are no taxes. Okay, so under this, if you have this guy, this person who owns 800 shares of equity, assuming that the firm dividend payout rate is 20%, we're supposed to be finding the cash flow for the shareholder. All right, then. So first of all, I got all these numbers over here. This is gonna work for me later. Note this taxes because this is a zero tax exercise. So never mind to that. All I have to take care of here is to notice that the number of shares times the price, that's the total equity that we have. So under this capital structure, we have these earnings before taxes, after taxes, I'm sorry, which is zero, right? So you get 18,000 pounds every year. Now the dividends are 20% of the earnings after taxes. So this is the money that's gonna be a split. I mean, 14,400 pounds are gonna be kept in the company in order for it to grow, to make investments, and to increase their working capital and stuff. And the other part, which is 3,600, we're gonna be splitting that up between all the shareholders. That means that the dividends per share are gonna be 3,600 divided by 3,000, which is the number of shares. Since this guy's got 800 shares, the cash flow is gonna be 1.2 times 800, right? All right. Now, for the other question, oh, this is the same. What will be the shareholders' cash flow be under the new capital structure of the firm? Assume that the investors will keep her 800 shares and that the dividend payout is still 20%. Okay, so we have a different animal over here. Do you remember how this was $135,000 pounds? Well, that's gonna be split between your equity and your debt. And since I don't have any more information, what I assumed was that this company took some debt from the bank at 8% to repurchase a few stocks. So that's basically the core of this exercise. So instead of having 3,000 shares, now you have 2,250 shares. And the price is still 45. There is no other indication that it should be changing that, so I'm going to keep it at 45. So the total equity is going to be 101,250 pounds. But your earnings before interest and taxes remain the same. The only thing that changes is the interest expense, which in this case it's going to be 33,750 times 8%. Okay, so let me just go back for a second. This amount of money over here, you calculate that by multiplying the old total equity, which is still going to be the total equity plus liabilities that I presumed, times 25%. And the rest, it's going to be equity. So if you add this up, look that it adds up to 135,000. 135,000, yes. Okay, great. Now, 8% of 33,750, it's going to be 2,700. That's negative. So your earnings after taxes or after paying your interest are going to be 15,300. So your dividends are going to be 20% of those earnings after taxes. Since the dividends to be evenly split between all shareholders is 3,660, excuse me, we're going to be dividing the dividends by the number of shares. So that'll get you 1.36 pounds per share. Since this person, this lady still holds 800 shares of this company, the cash flow for this shareholder is 1,088 pounds, which in change, we can see that it's a lot better than the position that was before, as you can see. All right, that takes care of question number 2. Now let's go to number 3. And for number 3, we have that a couple will retire in 50 years. So they have 50 years to save money until retirement. But they plan to spend £30,000 every year for 25 years, which I think they believe they're going to be living until they're, I don't know, like 100, I guess, because, well, whatever. Well, never mind. They still have to make 25 withdrawals of £30,000, okay? They believe they can earn 8% interest on their retirement savings. So they need to make an annual payment into this plan. So how much are they going to be how much do they have to save into this plan at 8% in order to be able to withdraw 25 times $30,000, or which is the same, 30,000 pounds every year for 25 years after this 50 years period of time in which they are going to be saving money. Okay, so the first thing that we need to find, this is just to check. Okay, I'll talk about it later. This is just the final balance that you're supposed to be having in 50 years. I mean, what I did was to bring to present value, and that's the present value that's going to be yourself in 50 years. I mean, 50 years from now, I'll bring all the future values, which are the payments, the £30,000 payment for every year, to the year number 50. The year number 50. So how I did that was the present value of the rate. In our case, that's going to be 8%. Now, the number of periods, that's going to be 25, because you're going to be withdrawing 25 times, I mean, every year, and so on. And the payment, that's going to be minus 30,000. And don't worry about the negative value. That's just for you to get a positive value in the result. And I get this $320,000, 243 and 29 cents. Those are pounds. I'm sorry again, but well, okay, yeah, now you understand. Okay, so in order to get that, I'm gonna be making annual payments of $558.14. And how did I do that? Well, there is a function here which is called payment, PMT, and then you go to rate, and the rate still being 8%, comma. How many payments are you gonna be making? I mean, how many times are you gonna be saving? That's gonna be 50, because you're gonna be saving for 50 years. You know what I mean? Okay, here I have 25 because I will be withdrawing up 25 times. Here, PMT, this is gonna be 50 because I'm gonna make 50 deposits. Now, comma, and it highlights the present value number, which we do not have, but we have the future value, which is the final balance at retirement. So that would be minus the previous result. And then you have 500 on 58.14. Let me just go ahead and do this again so you can see what I did over here. I'm gonna erase this real quick. So you got an initial balance of 0, and then you have this interest rate, which is gonna be always 8%. Okay, so the payment, I'm just gonna be let me just go crazy about it. I'm just gonna go like 450, although I know it's not that, but trust me, it's gonna make sense very soon. All right, so the final balance, that's gonna be your initial balance plus your interest plus your payment minus your withdrawal. All right, and your initial balance of year 2, it's gonna be the final balance of year 1. All right, so I drop down this one, and I'm gonna link the cell below, above, for this one, and that I can drag down. Now just go ahead and double click over here, and I have all this, but let's just correct one thing over here. We're gonna be saving until year 5051. It's not gonna be for us to save, it's for us to be withdrawing stuff. So that's gonna be, well, let's see, I think $30,000, and I'm gonna be linking that all the way to the very end. All right, then we're all ready. Okay, so you go to the data, what if analysis, go seek, set cell, that one to the value of 0 to change the cell, the one on top. Here goes crazy for a second, then you get the same value as you did over here. See? So that's basically it. If you have any questions, just don't forget to call, and I'm gonna be just in case you just want to pay uh, this certain amount, because I believe you have to pay like 6 hours and stuff on Preply. You can just go ahead and pay me on PayPal. That's gonna be my PayPal. That's my PayPal. So if you want, well, yeah, yeah, I think this is probably it. Yeah. Okay, so see you later. Bye.